What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Happy Thursday everybody. A couple of quick updates about yesterday's video before we move into the main stories. As we anticipated in yesterday's video, many Chinese stocks which were hit very hard last week and on Monday and Tuesday of this week, by Wednesday, yesterday, had relatively low prices and would have looked very tempting and attractive to investors with very high risk tolerance. Over the last 24 hours, the Nasdaq Golden Dragon China Index, a modified market capitalization weighted index comprising of companies whose common stock is publicly traded in the United States and the majority of whose business is conducted within China, this index jumped 30%. Chinese internet company Pinduoduo led a bunch of Chinese internet companies that also saw a huge surge in their stock prices. Pinduoduo jumped over 50% in trading on Wednesday off a very low base. It is still down, of course, 71% year on year. Alibaba Group Holdings Limited rallied 37%. In its biggest gain since its trading debut in September of 2014, adding about $76.5 billion in market value. JD.com Inc. and DD Global Inc. Each gained at least 38-39% in trading yesterday. All of these companies are American depository receipts. Like we said yesterday, these are mechanisms for Chinese companies to be traded on US exchanges. We should note, as we look at these big increases in stock value from yesterday's trading, the Nasdaq and the S&P 500 also saw a decent performance yesterday, seeing decent gains for investors. But what we shouldn't ignore, though, is that the Nasdaq Golden Dragon China Index and these Chinese technology stocks jumped from an almost 1 decade's long low base. Even after this 30% bump yesterday for the Nasdaq Golden Dragon China Index, the index is still down about 60% year on year, while the Nasdaq 100 index, for example, is up almost 6% year on year. But there is more to all of this than just a low base for buying to explain the surge in some of these Chinese stocks in trading on Wednesday. The most likely reason for the jump in Chinese stocks yesterday is because of a special meeting of the Financial Stability and Development Committee, FSDC, chaired by Vice Premier Liu He, the same day yesterday. During this meeting, the special committee signaled that the government wants stability in financial markets and more clarity in regulatory actions. Now we're going to be looking at this as well as the Chinese stock situation, particularly technology stocks, later in the episode. But first up, this week US bank Morgan Stanley cut its forecast for China's economic growth this quarter to 0, just a few days after Premier Li Keqiang committed China to achieving an ambitious 5.5% growth this year. Morgan Stanley came to the eye-raising forecast, which is being debated among economists and analysts still this week due to several factors. But a major factor is renewed lockdowns of megacities like Shenzhen and perhaps even Shanghai as a stubborn wave of COVID moves through the country. This being the case, let's look at the outbreak and lockdown situation first and then move into the economic aspects of all of this. As we have said time and time again, because China employs a strict zero-tolerance policy, what Chinese officials call a dynamic zero cases policy, even just one case can result in an expensive and disruptive government response. And it's not just one case we're talking about. We're seeing thousands of official new local cases being announced every day across 31 provinces and regions. This list, or the list of where cases are now being found, is now longer than the list of where they are not being found. The region being hit the hardest this week is Jilin in the northeast, near the borders with North Korea and Russia. As of Wednesday, 8 temporary shelter hospitals, first erected during the early days of the pandemic in Wuhan, have been put into place in the cities of Changchun and Jilin to treat the influx of patients. These cities are also heavily locked down. According to statements from local officials, the cities only have medical resources for 2 to 3 days, and so more support will be needed from other provinces and the central government. A senior expert at the Chinese CDC, speaking to state media today, said that in the future, when China relaxes its COVID-19 policies, those without symptoms can just stay at home for self-quarantine. This is different to in the past when they would have to go to hospital. This is also similar to the method that Hong Kong is currently using. Yet he emphasized that, quote, "This scenario would be feasible only when China has built strong immunity with effective vaccines, medications, and cooperative measures in hand." End quote. The economic megacity and symbol of China's modern economic performance, Shanghai, is slowly tightening controls too this week, but still seems unwilling to pull the trigger on full-scale, strict citywide lockdowns, likely due to concern for the devastating economic impact such a move would cause, as well as perhaps concern that full lockdown would be very unpopular among Shanghai's wealthy and collectively powerful urban middle class. Indeed, local officials this week said a citywide lockdown would not be implemented in Shanghai, like it had been in other cities. On Tuesday, a Deputy Secretary General of the Shanghai Municipal Government expressed at a press conference, quote, "We keep adjusting our strategy in accordance with the situation on the ground. We have not locked down the city, and there is no need for such measures." End quote. Nevertheless, restrictions are tightening this week. One 632-meter skyscraper in the finance and trade zone of the city, viewed by some as China's Wall Street, was sealed off on Monday. Restrictions have been put in place for meeting in public areas, eating at restaurants, taking transportation, and entering or leaving the city. International flights have been diverted to other cities so that authorities are not overwhelmed at Shanghai's 2 international airports. Shenzhen, the technology megacity bordering Hong Kong, in contrast, is in full city-wide lockdown. However, according to a statement yesterday, Wednesday, Foxconn's 2 Shenzhen campuses, one of which makes iPhones, will partly resume activity. The Taiwanese company said that it won approval from local authorities to restart activities after adopting a so-called closed-loop management process across the site. And on Tuesday morning, Langfang, a city of just over 1 million people, which neighbors the sensitive capital, Beijing, went into full citywide lockdown too. Okay, let's transition from the lockdown and the outbreak to the economic effect as well as the economy generally as we move into the second half of March. In a surprise to some, the People's Bank of China, China's central bank, decided to keep the rate on its 1-year medium-term lending facility loans unchanged this week. The bank expressed that China's economy perked up somewhat in the first 2 months of 2022, with key indicators, except in the property market, all exceeding analysts' expectations. However, a surge in Omicron cases, property weakness, and heightened global uncertainties are now very much biting the Chinese economy in March, and investors are not as optimistic as the People's Bank of China. This week, Wall Street bank Morgan Stanley cut its economic growth forecast for China to 0 for the current quarter versus the final 3 months of 2021, and predicts that Beijing will miss its annual target this year, lowering its 2022 China forecast to 5.1% for gross domestic product in the country, below the 5.5% set by Beijing during the National People's Congress just over a week ago. In a research note published this week, Morgan Stanley economists expressed, quote, "The double lockdown sent a clear message that Beijing is prioritizing COVID containment over the economy, and the recalibration of its COVID strategy will likely be delayed. Higher infrastructure spending and an easing of housing policies can be expected, but the larger issue remains finding a COVID exit strategy." End quote. I agree with this analysis, and perhaps so too does the white-knuckled Vice Premier Liu He, who chaired the Financial Stability and Development Committee under China's State Council yesterday, Wednesday, calling for stability in financial markets and more clarity in regulatory actions, and urging measures to, quote, "keep the country's major economic indicators within an appropriate range and maintain stable operation of the capital market." End quote. The statement appears to be a strong sign to investors that they can pour back into the capital markets, and this is exactly what we saw yesterday on Wednesday in the capital markets, particularly surrounding Chinese technology stocks. Liu He and other economic policymakers on the committee are obviously very aware of the many concerns investors have for the Chinese economy, as the meeting readout basically touches on every major concern. On the economy generally, quote, concrete actions must be taken to bolster the economy in the first quarter, end quote, noting that, quote, monetary policy should take the initiative to cope with the situation, end quote. For the property sector, quote, it is necessary to timely study and suggest effective risk prevention and mitigation solutions and put forward supporting measures, end quote. For technology companies suffering from regulatory crackdowns, quote, relevant departments should improve and establish plans to govern the sector, end quote, and there should be more clarity in regulations. The meeting even insisted that it would do more to improve the situation for regulation over US-listed Chinese firms, vowing to continue enhancing communication with US regulators and try to reach an agreement on US-China audit cooperation as soon as possible. It will also strengthen, it says, cooperation between the mainland and Hong Kong capital markets. We remember one of the reasons US traded shares of Chinese companies had been crushed last week and the beginning of this week was that US regulators named 5 Chinese companies last week that could be kicked off the American stock markets for failing to meet audit requirements. Indeed, it was reported yesterday that the US Public Company Accounting Oversight Board, PCAOB, which is overseen by the SEC in the United States, has been meeting with Chinese authorities in an effort to reach an agreement that would give it access to accounting firms on the Chinese mainland and in Hong Kong that have registered with it. So how should we view these Wednesday statements from officials in China? Or at the very least, how are investors reacting to it? Washington-based veteran China analyst Bill Bishop observed on these points this morning, quote, the readouts show how worried policymakers have become about the markets, real estate, and the economy. But I would be cautious in assuming that the messaging from Liu He and other financial regulators means the tough days are over. They are certainly trying to send a signal that they don't want markets to go down more, but it is not clear this is a real shift or more of a to stabilize things, end quote. As we've already said, many Chinese stocks and technology stocks in particular rallied after the meeting. Some investors believe that the statements from these officials represent the, quote, regulatory risk premiums going away, end quote, pushing back against JP Morgan Chase & Co.'s position recently that some Chinese internet firms have turned quote-unquote uninvestable in the short term. However, other investors, domestic and international, remain skeptical. Liu Zheng, fund manager at Hong Kong-based Fang Yi Capital Management Co., expressed yesterday on the meeting announcements, quote, sentiment wounded will take time to mend. This definitely shows that the higher-ups are highly attentive of the capital market, but we don't think there are any opportunities at this point that are just too big to miss out on. Instead, the risks to buy on this signal could be larger, end quote. And of course, regulatory risk from officials was only one of several concerns from investors, the others being the property sector and the geopolitical environment, as well as other risks. Quote, regulatory risk was the biggest worry for investors, and they are right now breathing a sigh of relief on Beijing's speech. However, it still leaves the geopolitical risk out there. That's something that has to play out, but that usually takes a little bit longer. End quote. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.